even though yesterday was not a strong trend, it was still fairly climactic over the past 5 hours. That reduces the chances of a big bear trend today. Also, it's got stuck at the 60-minute moving average for a couple hours at the end of the day, telling us the market's paying attention to the 60-minute moving average. 60-minute chart, very strong trend, but above it and far above it for a lot of bars. So we may have to do this and trade around it for a few days. I've been saying that we should get up to that February 2nd high, and I still think we will, but I think we probably will drop below the March 3rd high first. So I think, it's possible we'll go up above this high by a little bit and then come down here, but we're probably coming down there and test it. I want to make what I think is an important point, and I've said many times that the market needs to get 2 closes above this to get a new all-time high. And if we go above it and get 1 close above, you got to wonder, it's still a possible double top. So it could be a higher high double top, could be a lower high double top. When the market makes a double top, the second leg up is usually either a buy climax like this. So if we were to reverse down from here, it would be a lower high double top. Alternatively, if we dip below this and go up a little and then go up a third time, we could get a wedge, 1, 2, 3, a wedge rally to a double top. So this could be 1, pullback 2, pullback 3, or this could be 1, this could be 2, pullback, and then 3. And double tops, oh, sorry about that. Let me turn off the screen for a second and fix that. Double tops often don't look possible. You look at the second leg up and you think it's a bull trend. How can it be a double top? But as I said, the second leg up is often strong. In a double top, the second leg up can look like that, a very strong breakout, yet it reverses. It fails to get much above that, or here we did not even reach it, and we got a reversal and about a measured move down. 2/3 of the time, the second leg is a wedge or a complex rally with 2 or 3 or 4 legs in it. So a wedge rally to a double top, or a buy climax to a double top. And then you break below the neckline. The neckline is the lowest price between the 2 tops, and you look for a trend down. Now, I know you look at this and say, well, Al, how can it possibly reverse? And now we've had 3 extremely strong rallies. Those 3 extremely strong rallies reduce the probability that we're going to reverse. All right? Well, just because the probability is less does not mean it's impossible. There's always a real possibility of the exact opposite happening, the exact opposite of what you think is likely. We're obviously closer to this than we are to that, and the momentum up has been very good. So there's probably a 70% chance we're going here before we go below this. But I think there's a 30% chance we go below this before we go much above that. And what will happen if we go below this? Will they buy it again? Very strong buying, very strong buying, very strong buying. So very strong buying at this price. What will happen if we go below that? Well, in general, whenever you fall below a stop location, you should assume 50-50 chance the market will continue down for some kind of a measured move, 50-50 chance it'll reverse up. So if we do break below this, it'll be a 50-50 chance that we fail and form a bigger wedge, 1, 2, 3, 50-50 chance we'll go down for a measured move. And a measured move is pretty far because, this is 500 point stall. That would get us down here. So right now, 30% chance we're going below this. If we do get below it, 50-50 chance we'll go down here. So don't exclude the possibility of the market breaking below this and going far below. And what would cause it? Well, the obvious thing is Russia using nuclear weapons, tactical nuclear weapons to wipe out a city, possibly Russia using gas weapons to wipe out the remaining residents of Mariupol, right? And then possible something that we have no idea, just a total surprise. Right now we have a double top 76, a very big bear bar closing on its low. But look at the two moving averages over the past couple of hours. They're near one another, they're flat, and we're in this tight trading range again, so possible final flag. While this is a possible high of the day, it's not a very high probability bet. In general, whenever you have something that you think is not as high probability as you want, it's better to wait for some kind of confirmation, like 2 consecutive bear bars, or a close or 2 below these lows. This is testing last week's high on the weekly chart. Last week was a big bull bar closing on its high, so theoretically a buy signal bar for a double bottom or a truncated wedge, 1, 2, and then 3. And the market's deciding what to do. We're also at the 20-week moving average. Support, 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 support. And now we're below it. So possible resistance, resistance. So we're at an important price. Market's deciding what to do. On the daily chart, I said what I think is likely is we're going to pull back below this before we go above that. But we may bounce first. However, this is a really important breakout point. We're getting lower highs, lower high, lower high, lower high, lower high. And now we no longer have a lower high. So something has changed. A bear trend is lower lows and lower highs, lower low, lower low, lower low. And then we get a higher low, and now we have a higher high. So it's no longer a bear trend, but it's not necessarily a bull trend. It could be a trading range. And the market's deciding, are we in a trading range? The top of the range around here, maybe a little bit higher. The bottom of the range around here, maybe a little bit below that. Or is this a resumption of the bull trend and we go above that? We've been sideways now for about 8 months. Look at the screen. When you look at the screen, you say, wow, what a great bull trend. Or you say, wow, no. That's a pretty big sell-off, and we're just back to the middle of it. Maybe it's a trading range. Or do you look at the screen and say it's a bear trend? This is a double top bear flag. We'll break below the neckline and fall for measurement down. There are arguments for all three. And when things are not clear, you have to assume you're in a trading range. So I would say the market's been in a trading range since, August, July. So it's not stupid to sell below 1. I would not do it. We're at the bottom of a trading range. We broke below the range and we reverse up back into the range. And the market's deciding, are we going to stay here? Is it fair? A fair price? Should we stay here for a lot of bars? Or is this reversal the start of a bull trend? Is 1 a pullback in a new bull trend? Wedge bottom, 1, 2, 3, reversal up. The gap up is the reversal up. And 1, it could be a pullback. For the bears, it's a pullback in a bear trend. So we get a bear trend, and this is just a pullback, and they want the bear trend to resume. Look at what took place here. Lots and lots of reversals. And we're at that price again. And the two moving averages are flat and near one another. That represents a trading range, and it increases the chances that we'll go sideways more. So for the bulls, it's a high 1 buy. The gap up is a bull trend, and 1 and 2 are pullbacks. but it's 2 bear bars, so you don't want to buy that. For the bears, they have enough for a sell to close bear trend. They have 2 bear bars, one of them having a big bear body and closing near its low. So that's enough for traders to sell the close of 2 and put a stop above 1 and hope that 1 remains the high of the day. I think it's better to get more information. More information means more bars, so better to wait a little bit. Globex chart, we have wedge 1, 2, 3. We have a new high after the wedge began. That's common. The market often transitions from a bull trend into a bear trend, and the bull trend often ends before the bear trend begins. So you often get one more new high after the first leg down of the bear trend. We're right in the middle of the Globex range, and we've had a pretty good rally, pretty good sell-off, and it's basically a 50-50 bet that will go here or here. Now, I said the bears have their stop above 1, so therefore you could sell at the market, sell a bull bar, betting it will be a bull trap, like yesterday. Bear always in short, bull bars, traders will sell. A lower low after a lower high, bull bars, they'll sell. Bull bars, they'll sell, right? So just like it's not stupid to sell below 1, it's not stupid to sell here below the high of 1. But I'm not going to do it. The math is not good enough. For the bulls, I said 1, 2 formed a pullback in a bull trend. So the bottom of the bull trend is here, the top of the bull trend is here, and the 2 low is a 50% pullback, and it's a test of that high, and it's a test of the bottom of that range. So we got a reversal up, big sell-off, big reversal up, a pullback, and a big reversal up. We broke above 1. That's where the bears have their stops. So it's no longer sell the close, but is it buy the close, or is it simply testing the top of the range and will we pull back? Right now we've got 2 legs up. We got the gap up, a 50% pullback, and a second leg up here. Can the breakout be successful? We're trying to break out of the top of the range and above the high of the day. The odds will increase if 3 closes near the high of the bar and above the high of 1. Can today be a strong bull trend day after having 2 bear bars, 1 very big? Yeah, that happens all the time. The market on the open, no matter how strong a move is, 50% of the time it's the wrong direction. It's a test of support or resistance, and then the market goes the opposite way. 2 big bull bars that remain the high of the day. So a very big rally, high of the day. Two big bear bars, low of the day. So don't assume that a big move on the open means the market has to go that way. It often goes the opposite way. Right here, the market is deciding whether to form a strong bull trend day, close above 1, close on the high of the bar, and then get a follow-through bar on 4. That would all increase the chances of a strong bull trend day. Or if we're going to go sideways more, we've been sideways now, this is the 4th day. You say, wait a minute, we're not sideways 4 days. We went up and then we went down. Yeah, but just, look at the chart over here, 5-minute chart. Strongly up here and then down and up and now down and up again. So sideways, this is the 4th day of sideways. The bulls see the bear channel as a bull flag, a wedge, 1, 2, 3, and they're hoping that we resume the bull trend. And the bears are hoping that it's a bull leg in the trading range, that we form a double top here or a double top here or a double top there, and then get a leg down. Okay, so we have information. We have a big bull bar. It broke above 1, but it did not close on the high of the bar. It did not close above 2. So the bulls did not do all that they could have done. So bullish, yes, but the bulls need more to convince traders that this is the start of a bull trend instead of just a bull leg in a trading range. And then look at this, right? So you look at that and say, wow, what a great bull trend. Or do you say, wow, that's messed up. Big gap up, big bear bar, big bull bar, big bear bar, right? It's still unclear. Right now, I think it's more bullish than bearish. We broke to a new high today, and we reversed up strongly from below the 60-minute moving average, last week's high, and yesterday's trading range. But unless we break strongly above the top of the range, 64, then we still might be going sideways here for an hour or two. The minimum that the bulls want is no bear body. Then we'll have a bull surprise bar and no bear body. That would be confirmation, and you'll start to get more bulls willing to buy. But a lot of bulls want to see a close above the 64 high, or at least consecutive bull bars with at least a pretty good body on the second one. And does not look like we'll get it. So the bears, a micro double top 1, a lower high double top 64, a second sell signal, but a tail, a new high of the day 3, and big bull bar 3. So probably limit order market. 2, a bad buy signal bar. So some bears sold the 2 high, sold more 5 points higher, 10 points higher, and then they'll look to buy back their shorts at the 2 high. So we're probably going to dip at least a tick below the 2 high, and then those bears buy back the shorts, and then we get a high 1 buy signal bar. 5. 4 is already a high 1 buy signal bar. But traders don't like to buy at the top of a trading range, and they don't like to buy bear bars, above bear bars. So not a good stop entry buy above 4. For the bears, I think it's not a good sell below 4. So it's not a good stop entry buy above and not a good stop entry sell below, then that means there probably are more sellers above, more buyers below. And that means limit order trading. If 5 closes on its high and does not get too big, it will attract stop order buyers, but it's probably already too big and did not quite reach the moving average. Now, why is it going up? Because you had bears who sold the 2 high, sold more 5 points higher, 10 points higher, and they're disappointed by the tail on the bottom of 4, and they had limit orders to get out at the 2 high. We did not dip 1 tick below the 2 high. So as it started to go up 2 or 3 points, a lot of the bears who sold during this rally are panicking and buying back their shorts. Then you also had bulls buying the 4 low, thinking it's a bad sell. You can see double top bears, well, traders bought below the sell signal bar 4. And for the bulls, a bull trend 3, high 1, 4, traders sold above the buy signal bar. So 4 is a buy signal bar and a sell signal bar, but there were buyers below it and there were sellers above it. So opposite. And that is trading range trading. Better to wait. Everybody's eager to trade, especially in the first hour or so, because it's the highest probability time of the day for a swing trade. And I always try to get trades as early as possible in the day because the probability is higher. And the risk and reward is better. But you need a good sell signal bar and you need good context. You need a good signal bar and good context. We're not getting good signal bars. Buying above 2, buying above 4, selling below 4. And the context is bad. Strong reversal up, so you're not eager to sell. Top of a trading range, you're not eager to buy. Outside up, bull bar, but again, close below the high of 4, below the high of 4. Hard to see, but 5 did close above 1. So that's something good for the bulls. I think better to wait. What happens if 6 is a bear bar closing near its low? Then you have a double top 64, and you have a wedge. And you see the wedge? The wedge is, we went down on 1, down on 4, and if 6 is a bear bar, then we'll have gone down from the 5 high to the 6 low. And you will get bears willing to sell if 6 closes on its low and has a decent bear body, maybe a couple points bear body. Bulls are hoping 2 remains the low of the day, and they're hoping the strength of the rally increases. They need to start to get bull bars closing on their highs and closing above things. But we got a bunch of stuff, you know, resistance, 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 you know. So to me, we're stuck right now. And as I said, even if we go up, we've been sideways for 4 days. Here's a 15-minute chart. So sideways for 4 days. A bear channel, a wedge bull flag, 1, 2, 3, and a breakout above the trend line. But the breakout is tiny, and that's not good. If you're looking for a breakout, you want it to be a big breakout, closing with a big bull bar far above the bear trend line. And that's not what we have at the moment. Bear's trying to get the wedge. 1, 4, 5. The more 6 closes on its low, the more bears will sell and the more bulls will give up. We had a bull surprise 3. And that made it likely we would get a second leg sideways to up. 5 meets that minimum. It's a second leg sideways and a little bit up. 7 o'clock, there's often a report or a news announcement. So the market often moves quickly during the final second of 6 or at the start of 7. I'm looking at a calendar of events, and there's no news. I don't see any news scheduled to be released at 7 o'clock. Now, how can it be doing this? We reversed up on the open, a big gap up. We reversed up on 3. We reversed up on 5. And now we got a decent sell signal bar for a wedge rally. Confusing. You could see bulls buying the close. They don't want 7 to go below 6 because that would trigger a wedge sell. Should you sell below 6? We got 4, now 5 sideways bars that are pretty big. So a tight trading range within yesterday's trading range. You know, it's the single best stop entry signal of the day, but it's still not all that good. So of all the stop entry trades we've had today, below 1, below 4, above 2, above 1, above 4, this is the best one. Bulls, they have a high 1, 6, and we did not trigger the sell below 6. But 6 is a big bear bar at the top of the range, so not a very good buy signal bar. Okay, we just triggered the high 1 buy. Bulls trying to get a breakout above 5, and then a measure move up. A breakout is a close above the high of the prior bar, a bull breakout. So a bull breakout is a close above the high of the prior bar. 3 broke out above 2, A breakout's also better if you break above prior bars, and we did. We broke above the past 10 bars on the open of bar 1, but we did not close above those bars. Bulls hoping 7 will close on the high of the bar and above 5. Failed wedge top, possible measure move up. Gets us to near yesterday's high, and that's above the Globex high. The Globex high is around here. When things do not look as good as you want, yet they're reasonable, it's okay to trade them, but trade very small. And then if the market continues your way, you can add to your position. So for the bulls, they want 8 to close on the high of the bar and above 5 for possible measuring gap. If they get it, you can trade small. Trade small like 20% of a normal position. Put a stop below 7. And then if it keeps going up, you add to it. And if it reverses, you get out with a small loss. The minimum that the bulls want is a close above 5. What they really would like is 5 to close on its high. And then they'll want a bull follow-through bar on 8. I'm saying 5. The numbers are really small. They want 7 to close above 5. They want 7 to close on the high of the bar. And then they want 8 to be anything other than a bear bar. They'd like 8 to be a big bull bar closing near its high. But if not that, then at minimum, they want it to be a perfect doji, no bear body. So like bar 50, no bear body. That would be confirmation, and it would increase the chances we're going higher. So traders buying at the market, but you buy a small position if you're buying this. And because we're still in a trading range, it's reasonable to scalp out part. Bears still hoping for a wedge, 1, 5, 1, 5, 8. And bulls are hoping that this is the start of a swing up. Is the character of the day going to change? Is it going to remain unclear? Are we going to continue to get reversals and tails every few bars? Or is it going to become much more bullish? Are we going to start to get 2, 3, 4 consecutive bull bars and start to get bull bars closing on their highs? I said the bulls want a bull bar. Well, what happens if it's a bear bar? What happens if 8 is a bear bar? Then we get a possible wedge, 1, 5. 7, a bull surprise. All right, we did not trigger the sell below 6, surprising. And we broke out above 5 and reasonably far, the close is reasonably far above 5. So chances are we're going higher. But if 8 is a bear bar, especially a bear bar closing below its midpoint, the bulls will exit. Will the bears sell? If 8 is bearish enough, you'll start to get bears selling. Bears trying to get back below the breakout point, 5. Bulls want to keep the gap open. What happens if 8 is a bear bar but has a big tail below? Fewer bulls will exit and fewer bears will sell. The bears would like a big bear bar closing on its low and below the 5 high. That combination, you will start to get bears shorting. Globex high, not far above, right around here. So the bulls got the minimum. They have a bull body. For the bears, it's still a wedge, 1, 5, 8, but you'll have fewer bears selling below 8, and you'll probably have more bulls buying below 8 than bears selling. Now, do the bulls exit below 6? Yeah, I would get out below 6, but they might also get out 3 or 4 points below any bar, including below 8. Can this be the high of the day? Of course. But to me, it's not a good enough sell setup. The market's deciding. Are we going to get a measured move up, 8 low, 5 high, or is the breakout going to fail? Will there be more buyers at the 8 low or sellers? What happens if 9 is a bear bar closing on its low and below 8? More bulls will exit below 9 and more bears will sell. What's going on here? I don't think you have a lot of bears selling, but we're pulling back because not enough bulls bought the close of 8. And the bulls who bought above 5, some of them are selling out of their longs. If enough do, 9 becomes a big bear bar. So are the bulls going to give up, or are they going to buy more 8 low? Important bar, right? If it has a bear body, you'll have a lot of disappointed bulls exiting. Right now you have disappointed bulls exiting. Nine, a high one, a pullback in a bull trend, similar to 2, 4, and 6. And the problem with those high one buy signal bars, all were bear bars. And so far, 9 is a bear bar. How strong are the bull bars? How strong are the bulls? Can they get no bear body? That will increase the chances that will go higher. So far, bear bar closing around its midpoint. Okay, so bear bar closing at its midpoint. A lot of bulls will get out break even. Other bulls will get out below 9. And other bulls will get out below 6. And it's a high 1, but something's wrong with this bull trend. We now have had 4 buy signal bars, high 1 buy signal bars, every one of them a bear bar. 1, 4, 6, and now 9. And in strong bull trends, is that what you typically see? All the high 1 buy signal bars, bear bodies? No. So far, this is not a strong bull trend. For the bears, a possible wedge, but a bad sell signal bar. Why are we stalling here? Is it bears selling? No, it's bulls not buying. It's not a very good sell, so you don't have a lot of bears selling, but you do have bulls looking at this and saying, well, I was hoping for 7 to close on its high. I was hoping for 8 to close above 7. I was hoping 9 would not go below 8. I was hoping 9 would not have a bear body. I was hoping that if 9 had a bear body, it would only be a tiny bear body. And all of those hopes did not get fulfilled. So you have a lot of bulls disappointed. And so the bulls who are long, a lot of them are exiting. I exited. I bought above 5. I bought below 8, added to it below 8, and disappointed and got out. What happens if it keeps going up? Well, I'll keep buying. But if I'm disappointed, I will exit. If this is an early small pullback bull trend, it'll last for at least a couple hours, and we'll probably get a better buy signal bar at some point and better follow through at some point. I'm never in a rush. I wait for what I want, and if I get disappointed, I get out. You know, I want a trend, and this is a trend, but not a very good one. And therefore, it might simply be a bull leg in what becomes a trading range. Bull leg in a trading range, I do not want to be long at the top. I don't want to be long at the top of a trading range. Reversal, 10 reversing 5. Now, we have a gap, a body gap between these bodies and these bodies. And the bears are trying to get 10 to close below 5, the highest bull close in the breakout point 5. 5 high, and we're totally reversing it. Now, I said you had disappointed bulls selling out of longs, but now you're starting to get bears selling into shorts, thinking it's strong enough of a bear surprise so that we'll probably get at least a couple legs sideways to down. We're back in the middle of the trading range, back at the 2 moving averages. And yesterday we had an expanding triangle, 1, 2, 3, 4, 5, and then it grew 6, and then it grew more, 7. The reversal up failed, and then we got a new low here, and now we have a new high. So expanding triangle, 1, 2, 3, 4, 5, 6, 7, 8 reversals. Every time we get a new high, it reverses down. Every time we get a new low, it reverses up. Really a terrible location to sell. You're at 2 flat moving averages in the middle of an expanding triangle. If I was not talking, I would have sold during 10, probably around here somewhere. Right now, I'm flat. Bulls are hoping it's just a deep pullback in a bull trend, but they have a problem. They had a breakout 7 and follow through 8, and now we're back below the breakout point, the 5 high. And on a line chart, we're below the breakout point as well. So here's the 5 high, that's the breakout point, and we close the gap. There was a gap during 9, its low was above that breakout point, but now it's below that breakout point. So the body gap has closed. We have a gap between the body of 9 and the highest bodies here, but that closed the gap. Now there's overlap between this body and the body of these bodies. So it's no longer bullish. Now it's back to neutral. Not all that bearish. Just like bad buy signal bars 2, 4, 6, bad sell signal bar 8, and bad sell signal bar 9. What do you do? Well, if you're short, I'd scalp out part at 5 points. If you're flat, I would wait to see if we get a second big bear bar, 11. We're getting near the end of the first hour. And where are we? Right where the hour started, here. So we're in the middle of the hour and at the open of the hour. So here's the open of the hour. And you can see it's almost exactly the middle of the hour. Okay, so the open is right around the middle. We have about 10 minutes left, 2 bars left. And the bears tried hard on 1, failed. The bulls tried hard, 3, 7, failed. The bears are trying again hard to create a bear trend, but we're right in the middle of the trading range and at 2 flat moving averages. So not a lot of bears willing to sell the market and sell below 10. Since we closed the body gap and we have a bear surprise 10, we might get a second leg sideways to down. That will reduce the number of bulls willing to buy above 11. So probably better to wait. For the bulls, double bottom 5, but 3 bear bars, probably sellers above. For the bears, they have a bear surprise 10, bear follow through 11, but we're in the middle of a trading range open. We're in the middle of yesterday's trading range, and the 2 moving averages are flat. So for the bears, it's a low 1 below 11, but a limit order market, trading range open, and we're pretty low in it. So I think best choice flat, best choice wait. The bears who did sell below 9, who sold during 10, who sold the close of 11, their stop now is above 8, but I probably would get out 3 or 4 points above 11 instead of way up here. I'm currently flat. This is a trading range open, lots of trading range behavior. Bad buy signal bars, bad sell signal bars, bad follow through up and down. 2 flat moving averages next to one another. End of the hour. Is the hour going to close on its low? Is the hour going to close in the middle? 60-minute chart. When you look at that, you say, wow, what a great bear trend. Do you look at it and say, wow, what a great bull flag? Or you look at it and say, I don't know, it looks like it could go sideways a lot more. I think most traders look at that and say, we're way overbought, so no urgency to buy unless something is really good, and this is not really good. And the bears look at that and say, yeah, we're reversing, but it looks like more sideways than down, especially in a strong bull trend. So the bears don't want to sell, the bulls don't want to buy. And like I said, we could go sideways for several days, like after that strong leg up. R12 is always important because it affects the appearance of the first 60-minute bar. But I don't think the first 60-minute bar is important today. 4 or 5 bar trading range at the moving average. So not a good sell below that bar, not a good buy above that bear bar. So it looks like we're starting to go sideways 60-minute chart. And here, as I said, we've had repeated expanding triangles, bigger and bigger, and we're right in the middle. 4 consecutive bear bars, good for the bears. But do you really want to sell below 11, below 12 at the 2 moving averages? We're probably always in short. We have consecutive bear bars, 10, 11, with at least one of them having a big bear body closing there as low. So that's sell to close. And now we're starting to get closes below the moving average. So it could be always in short. Bears would like to see a couple closes, a couple consecutive bear bars closing below the moving average, with one of the bars being big and closing near its low. So if 13 is a big bear bar closing near its low, then this would be always in short. For the bulls, a micro wedge, 10, 12, 13, but 4 consecutive bear bars. That will reduce the number of bulls buying above 13, no matter how bullish it looks. Better to do nothing and wait for more evidence that the trading range is ending and a trend in either direction is beginning. You don't want to lose money, and you especially do not want to lose money in the first hour or two. The bars are bigger, the legs are bigger, so the loss is bigger. And then later in the day, when the bars get smaller, it becomes very difficult to make back the early loss. And then you spend the rest of the day hoping to make back half of the loss. And then you're miserable all day. And, trading has to be fun and profitable. And if all you're doing is hoping to make back a loss, you feel terrible. That's not fun. So do not put yourself in that position. You should be swing trading. This is not a swing trading environment. So better to wait. This is limit order scalping. You should not be trading like that. You should be waiting for some evidence of a trend in either direction. Double bottom, 5 but 4 bear bars, possibly bears selling 12 high, selling more 5 points higher. And bulls are trying to get sustained, strong bars. They want consecutive bull bars closing on their highs, not 7, 8. And the bears want consecutive big bear bars closing on their lows, not 1, 2, not 9, 10, or 10, 11, or 11, 12. So far, no sustained buying, no sustained selling, lots of reversals. We had a big gap up on 1, reversing yesterday's sell-off. Then we had a big bear bar on 1, reversing the gap up. And 3 reversed 1. And and then 10 reversed 7, and 13 is reversing 10. Really terrible for stop entry traders. Are we always in long or short? I think, remember I said I think the bears needed 2 bear bars closing below the moving average, and preferably decent sized bodies. So I think we're still always in long. For the bulls, a double bottom, high or low 5, but the 4 bear bars will reduce the number of bulls buying at the market and buying closes here. So good for the bulls, another reversal, reversing a bear bar, but traders are hesitant to buy too high, and they're hesitant to sell too low. Can you take a chance and buy the market? I think we're always in long. It's a bull surprise, so we should get at least a small second leg sideways to up. So bulls buying the close or buying above 13 probably will have time to decide. So if you bought 3, you had time to get out break even after you're disappointed. If you bought 7, you had time to get out break even if you were disappointed on 8 or 9. If you sold 10, you had time to get out break even. And if you buy 13, you probably, if you're disappointed, you'll probably have time to get out break even. So it's okay if you can make quick decisions. Otherwise, wait. Big bear bar 1, they bought the close. Big bear bar 8, they bought the close. Big bear bar 10, they bought the close. Big bull bar 3, they sold the close. Big bull bar 7, they sold the close. Big bull bar 13, does it look like more sold it or more bought it? Well, right now it looks like more sold it. So traders are continuing to bet on reversals. Bears lower high double top 8, possible high of the day. Bad buy signal bar 12. So some bears sold 12 high, sold more 5 or 10 points higher, or 5 points higher, and they wanted to get at least 1 tick below 12 high so they can get out break even on their first sell and with a profit on their higher sell. Stop order bears, lower high double top 8, but after the bull surprise, and we've had 3 bull surprises, 3, 7, 13, I think that will limit the number of bears selling below 13. You can see everybody's eager. We're getting these quick moves, but then terrible follow through. Limit order trading. Anything bullish, they sell. Anything bearish, they buy. So you should not be doing the opposite. If it's bullish, do not buy. If it's bearish, do not sell. Wait for more evidence. You know, traders are, it's an opposite type of environment. So wait for more evidence of a trend. Remember, if it's going to trend, it's not just going to trend 3 or 4 bars, it's going to trend 20 bars, 25, 30 bars. So there's plenty of profit potential. So no problem waiting. The bears hope 13 is a pullback from the 10 reversal down. The bulls hope 13 is a pullback from the 13, they're hoping 14 is a pullback from the 13 reversal up. They want it to be like 6. They do not want 15 to go below 14. Since it's an opposite day, can you buy the 14 low and buy more lower? If it goes below 14, we'll probably go below the 12 high. So if you're looking for a limit order buy, it's probably better to buy at the 12 high instead of at the 14 low. And for the bears, a lower high double top. But after a big bull surprise, usually better to wait for a second signal or a micro double top. Will there be more buyers, 14 low, 12 high, or more sellers? At the moment, probably more buyers. What happens if 15 closes on its low and below the 12 high? That will attract more sellers. But the bears need to break below the moving average. Look at the first 15 bars and the moving average, right? We've had 1 close below the moving average today. So even though we've had lots of bear bars, and lots of reversals down. Only one bar closed below the moving average. So it's slightly more bullish than bearish despite all the reversals. What happens if we get consecutive bear bars closing on their lows with one bar closing far below the moving average? Then it'll become more bearish. Bulls high 115, but they'd like as good a buy signal bar as they can get. I had a buy signal bar, one tick above the 12 high, did not get filled. And now we're reversing up, so I'm going to cancel that. I don't want it to come back down again. I wanted to get down quickly to the 12 high and maybe a tick below 12 to have a higher probability of getting in. I put my limit order one tick above the 12 high in case it just touched the 12 high and did not go below and did not fill me. So I'm flat and waiting. It reversed up, which I thought it would do, but so it's done what I thought it would do. I don't necessarily think it's going to do it twice, so I canceled my order. I wanted it to go down and reverse up, and it did that, but it did not go quite down as far as I wanted it to go. So if it goes down a second time, I don't want that. I want it to go down one time, reverse up. I don't want it to go down a second time. So I canceled my buy order. Bulls trying to get a high 115, but they'll need as strong a bull bar as they can possibly get to attract buyers. The more 15 closes on its high, the more bulls will be willing to buy it. But 14 disappointing. So a lot of bulls who did buy 13 or 13 close are going to try to get out break even. So will bulls who bought 13 exit here, or will bulls buy? Reasonable buy for a swing. And for the bears, can you sell? Arguing they've sold the close of every bull bar all day. I would either buy or wait. What happens if we get a bear bar 16? That would be a second reversal down. Bull surprise 13. You expect a second leg sideways 2 up. And 15 is a second leg sideways 2 up. So if we get a decent sell signal bar 16, it would be a credible sell. Bulls are hoping that this is the start of a bull trend. If you bought, better to buy small. And if we start to get 2, 3, 4 bull bars, you can add on. Bears double top 8, 14. Bulls want to break out above the double top and a measure move up to yesterday's high. We have not had consecutive bull bars closing near their highs today. We have not had consecutive bear bars closing near their lows. So if we get consecutive bull bars closing near their highs, that would be a change. It will start to attract buy the closed bulls. Bears trying to get double top 8 with a good sell signal bar. Double top, micro wedge 11, 14. What happens if we have a bull bar but a fairly prominent tail on top? Well, that will reduce the number of bulls buying closes and buying above. The bulls really need a pretty good bull bar here. We're in that window starting bar 16 when the market often tries to reverse. So starting bar 16, bar 18 is pretty much the middle of the window. Micro wedge 11, 14, but consecutive bull bars. So not good for bears to sell below 16, but a lot of the disappointed bulls are getting out, or they'll get out a couple points below 16 or below a bear bar. Testing the entry price for the bulls who bought above 15. If it's not a good sell, probably more buyers than sellers below 16. But disappointing at the top of a trading range open. So a lot of the bulls are exiting 17. Can you buy more below 16 or at the 16 low? Small pullback bull trend. Well, we're in a small pullback bull trend since 13. But it's, with all the reversals, and it's a second leg up. I did buy above 15, and I get out like with a 2-tick profit during 17. And if I was confident that this was a small pullback bull trend, I would have bought again 16 low. But I don't like buying at the top of a trading range. So currently I'm trapped out, and I'll have to look to buy it again. And it's not bearish enough for me to sell. Bulls trying to get a third consecutive bull bar, first time all day. And they really are trying to get breakout bars, closes on the high, above the high of the prior bar, and above a whole bunch of prior bars, or measuring gap. Double top, and move up gets us to around yesterday's high. I won 17, but not strongly bullish. A bear bar at the top of the trading range. I'm back to flat. If it goes above 17 and reverses, then wedge 13, 16, a wedge and a double top. It's slightly more bullish than bearish. As I said, only one close below the moving average all day, but it's still at the top of a trading range, so it's still a bull leg in our trading range. We have not clearly begun a trend. It's a small pullback bull trend right now, but within a trading range, so it could simply be a test of the 8 high and then the start of a reversal down. For the bears, the bad sell signal bar 16, bad sell signal bar 17. It's similar to 8, 9. They sold below 9. Will they sell below 17? I would not. Right now, I would either be long or flat, and I was long, and now I'm flat. High 1, 18, but bulls would like a bull bar. Otherwise, they'll wait for a strong breakout and buy higher, or a pullback and maybe buy a double bottom 15 at the moving average. You can see just how terrible this is for stop entry traders today. It's a trading range open limit order market. So you got to be patient and selective. And really, in terms of stop entry trades today, the only one that made sense, I thought, was buying above 15, and the entry bar was disappointing. Tail failed to break out above 8, and then follow through 17. So better to get out and wait for the next trade. The bears had a credible sell below 6, but did not trigger. I won, small pullback bull trend, but 2 bear bars at the top of a trading range. So I'm not going to buy above 18. For the bears, a double top 8, but bull bar 16, tail 17, 18. I'm not going to sell. It's slightly more bullish than bearish, but it's not doing quite enough. The bulls who bought above 15 theoretically can still be long, stop below 15. So therefore, theoretically, you could buy at the market and put a stop below 15. But I would rather wait to see if we get another buy signal bar. So what was the news? I don't know, but it's not what the bulls want. You can see some bulls bought with a stop above the double top, but they scalped. How do I know they scalped? Well, look at the tail, right? So they bought bought with a stop and tried to get 5 points and reversed down. The breakout was so extreme that a lot of the bulls had pretty good slippage on the breakout. Bulls are hoping the tail is a pullback from what will become a successful breakout, and the bears are hoping that it's a big failure. Different ways to look at the wedge: 1, 64, 8, and then 19, or the 1 high, 8, and 19. A failed breakout above a double top is also the same as a wedge. It's 3 legs up and a reversal. We got above the Globex high, which I said was around here. You can see on the 15-minute Globex chart, we broke above, but you can also see an expanding triangle: up, down, more up, more down, more up, which is similar to what we had on the 5-minute chart yesterday. Expanding triangle: 1, 2, 3, 4, 5, 6, 7. An attempt at 8, another attempt at 8. Big breakout, new high of the day, breakout above the double top, but big tail and close below the double top. That will reduce the number of bulls taking the buy. A lot of bulls will wait to see what the follow-through bar looks like, 20. Still always in long. The bears, bad sell signal bar, 19. They need a good sell signal bar, 20. And the bulls want a good follow-through bar, 20. Bull trend since 2, but a lot of big reversals and hard to just buy and hold. Sometimes we get a big breakout with a big tail, and then the next bar is a doji bar. And it's really important for the close of the follow-through bar, 20, to not have a bear body. Even a perfect doji body, a perfect doji, increases the chances we go higher. So the close of 20 is very important. A 1-tick bear body increases the chances that we're going to go down. For the bears to short, okay, so that's bad for the bulls, okay? A 1-tick bear body. And for the bears, a wedge, 64, 8, a wedge, 1, 8, but a doji, so not a very good sell. For the bulls, a high 1 and a small pullback bull trend. But all the breakouts today are failing. We broke above 1, we failed. Broke above 5, we failed. Broke out above the double top, we failed. So I think best choice flat. Second best choice long, but I'd get out below 18. And for the bears, it's not good enough for me to sell yet. High 1, small pullback bull trend, but a big doji. So the probability is less. And because the bar is big, the risk is big. Just not a good day for stop entry traders. You know, some days, this is about as bad a day as you can have for stop entry traders. It's hard to make money. It's easy to lose money, but if you're careful, you do not lose because you do not take most of the trades. You just wait. You can see high 1, small pullback bull trend, but possibly more sellers than buyers above 20. And for the bears, a wedge, failed breakout, double top, but a bear doji and a small pullback bull trend, possibly more buyers than sellers below. I am currently flat. You know, again, it's really important to avoid losing money. It's especially important to avoid losing money in the first hour or two. And sometimes the best way to accomplish that is not trade. And I think there's been only one credible stop entry trade so far today in 20 bars. That was buying about 15, and it was not very good. Can we continue up all day like this? Sure. Do I think we will? Nope. It looks like a bull leg in a trading range. So chances are we're either going to get a bear leg and then a big trading range, or possibly a reversal into a bear trend. I don't think a reversal into a bear trend, because we spent so much time at the 60-minute moving average, so it's pretty good support. But yesterday, we had a fairly weak rally, and bar 31 became the high of the day. And today, a fairly weak rally, and we still have 10 more bars before 31, and we might do a similar thing today and reverse down. So yesterday we rallied for a couple hours, and then we sold off for 4 or 5 hours. Today we're rallying for a couple hours, possibly then sell off. And if we sell off, will it become a bear trend? I think it probably will remain a trading range. We've been sideways now for 5 days. So now we got a high 120. We have a bull bar closing near its high 21. But traders are not stupid. They look at this and say, yeah, every time it goes up, there are sellers. So you'll have fewer bulls willing to buy above 20 or above 21. For the bears, the micro double top 20, lower high micro double top, but bull bar 21. So possibly more buyers than sellers below 21. Better to wait. Good for the bulls, consecutive decent sized bull bodies closing on their highs. But that tail 19 means at this price there were a lot of sellers. So again, it reduces the number of bulls buying. Stop for the bulls, I'd get out 2 or 3 points below any bull bar. And for the bears, they're trying to get a sell signal bar, micro double top 19. Part of the reason for 23 is some bulls bought at the very top here, bought more lower, and they're hoping it gets back here so they can sell out, break even on their first buy and with a profit on their lower buy. And that's how you create double tops. Here, rally, no chance to get out, break even if you bought there. When it got back to that price, there were some sellers. And a lot of these sellers are bulls who bought here, getting out without a loss. And that's what's taking place here. We went up and reversed down sharply. The bulls who happened to buy up here never had a chance to get out. They're hoping it would get back up here so they could sell out without a loss or with only a small loss. So you're always going to get bulls selling at a top where there was no opportunity to get out without a loss. And that's what's taking place here, 23. It's still a small pull by pull trend. We have a possible body gap, 20, the body of 20 and the body of 16. So it's still possibly a measured move up to yesterday's high, but not attracting a lot of buyers at the top. You know, we're at the top here, sellers. At the top here, sellers. Up here, we're at the top, and you got the bulls who bought here saying, wow, I did not want that big reversal. Therefore, it's not as bullish as I wanted. Maybe I better get out. Maybe I'm long at the top of a trading range or at the top of a rally that's going to reverse into a bear trend. And that's what's going on here. Disappointed bulls exiting. You get some bears selling, limit order market, traders selling above everything. But I think 23 is mostly bulls who bought in here, relieved to be able to get out with a much smaller loss than what they had a few minutes ago. Bulls trying to change the character of the day. They're trying to get 3 bull bars, 4 bull bars, 5 bull bars. They're hoping the body gap leads to a measured move up. I have the measured move from the 16 high, but these bodies and that close make me wonder if more computers are using that as the measured move, the space between these bodies, and that would be up there. Even though it's only a doji, it's the first time today 3 consecutive bull bars. So good for the bulls. Bulls taking chances, buying closes, hoping that we go up to yesterday's high. What happens if we go above yesterday's high? Probably sellers. Why is that? daily chart. It's a high one, but it's a bear bar. So it might be more sellers than buyers above yesterday's high. More and more bulls buying, more and more bulls confident that we're going up. Can this convert into a very strong bull trend? I don't think so, but anything is possible. You can see we're at the measured move based on the body gap. If you convert this into a line chart, there's a gap between that pullback and this breakout point. And the double top measured move up is right around there. Breaking out above the double top. Bar 24, multiple of 12, so it represents the end of the second hour. And so far, a good bar for the bulls. The bears will want a double top with yesterday's high, and the bulls are hoping the bull trend is resuming. Remember, I think we're going up here. What we don't know is, are we going to come back to this breakout point first? Is it by the close 24? When you get a 60-minute bar closing on its high, usually the next hour tries to go above the high of the bar. And therefore 25, okay, it just did and went above. But sometimes it'll only go a tick or two above and then reverse down for many bars. Obviously becoming more bullish, 4 consecutive bull bars, but it's also fairly climactic. Possible parabolic wedge 16.19 or 8.19. Trying to get above yesterday's high. Daily chart, good context, a strong bull trend, but bad buy signal bar, a bear bar. So probably sellers not too far above yesterday's high. If you buy this, I think I would not buy this. If you were buying, I think you buy above 22 or above 23 or during the breakout 24, buying at the high after a big bar. The math is not as good. Or what I was going to say is if you do buy it, I'd get out below a bear bar. I'd get out 2 or 3 points below a bull bar. What about shorting 25 if it's a bear bar? Wedge, it would have to be a very good bear bar. It's probably a minor reversal. The first reversal from a new high in a small pullback bull trend is usually minor. High vacuum test of yesterday's high. You don't have to get out below 25. It's reasonable to get out. We're probably not going to go a lot higher before we convert into a trading range. And for the bears, it's probably a minor reversal. The best they can probably get is a trading range. Yesterday was a bear channel, but it was also a trending trading range day. We were in a trading range and then another trading range. And today we began with a trading range. We have a breakout, and I suspect we're going to convert into a trading range here. Yesterday, a bear channel, but basically a trading range, a breakout, and then another. And today, a bull trend, but basically a lot of uncertainty in a trading range here, and then a breakout. So I think this is probably going to soon convert into a trading range. We'll start to go sideways for at least a couple hours, maybe all day. The bulls are hoping this is going to be a small pullback bull trend that lasts all day, but that's not what it's going to be. Why do I say that? Because of what I'm about to show you. Here are some examples of small bull trends that lasted all day. You can get a bull trend from the open that lasts all day, a bull trend from the open that rallies for about half the day and reverses, a bull trend from the open that goes sideways. Small bull trend day that lasted all day. Does today look like this? Very little overlap, lots of bull bars. There's no question the market's going up. Does today look like this? Same thing. Does today look like this? What about this? A little bit of sideways here, but pretty relentless here and pretty tight bull channel here. What about this? What about this? So the bull trends that last all day tend to look like that. Today does not look like that. The bears hope that it rallies and reverses, rallies and reverses. But what happens more often is it'll rally and go sideways, rally and go sideways, rally and go sideways. Today is a little bit different. It's really not a bull trend from the open. It's more like what I'm about to show you. It's more like this. A weak rally, basically a trading range, a breakout. Here we got a couple more legs up, but those legs up were part of an upper trading range. This is what is going to happen today. So sideways, a breakout, very strong breakout, but then sideways. Strong rally, but sideways. Pretty good breakout, and it worked higher, but at the end of the day, when you look at it, after that breakout, everything that took place was part of a trading range. Very strong breakout, but we had an earlier trading range lasting a long time. It increases the chances that this breakout is going to lead to a trading range. It can drift up, it can drift down, but we're probably going to be in a trading range for the remainder of the day. The bulls are hoping that we're going to get a gap, 26 low, 19 high, and a big measure move up. But we should not have had the kind of trading that we had for the first 23 bars. Too much trading range trading lasting too long. So yeah, it's a high one, and we'll probably go higher, but I don't think we're going to go a lot higher. And I think this breakout is the gap between a lower range and then an upper range. So if you buy above 26, maybe stop below 26. I think it's really not very strong by the close, because of all the things that can happen, the one that's most likely is this. Maybe a little bit higher. If it's a pretty good leg up, maybe we'll get one more leg up. But this is probably what the next several hours will look like. Is it by the close, by the market? We're accelerating up. It is, but you got to be quick to make decisions, because we're probably going to convert into a trading range within the next 5 bars or so. If this is a bull leg and what's going to become a trading range, and you sell, I think right now it's not worth selling. I think theoretically, if you sell and sell more higher and risk 20 points, you'll probably make money. But at the moment, I think it's better to either be long or flat. And I think a lot of the bulls know that a trading range is likely, and therefore, instead of buying and holding, they'll probably buy and take profits 5 points up or so. Still buy for any reason, becoming increasingly strong. But like I said, you can get a strong leg that still ends up evolving into a trading range, and I think that's what's going to happen. Reasonable for bulls to exit below a bear bar. 27 high, 22 ticks above 26. That's exactly where it had to go for bulls to scalp out 5 points. And you can see we hit it in reverse. Tells you that a lot of the bulls scalp for 5 points. So they're less confident that we're going a lot higher. I would get out of longs below 28, but very strong bull trend, small pullbacks. While it's possible it's the high of the day, I think it's not worth shorting unless you're willing to use a wide stop and scale in higher. I would rather wait for a second sell signal. Can you buy the 28 low like 25? I would not. 24, bull surprise, second leg up likely. Well, we've had the second leg up. Plus possible parabolic wedge, 19, 25. So I'd be out of the longs, but to short, I think it's better to use a very wide stop because we could easily go up to one or two more brief new highs. Can you sense that something's wrong with this bull trend? If you do, you got to think about how you would put it into words. For me, a lot of trading means trading for the first 18 bars. The breakout 19, terrible follow through. Bear bar 25, it triggered a sell. 26, and went exactly 22 ticks up in reverse. So bulls are taking quick profits. So probably a trending trading range day. Remember I said yesterday reversed at bar 31, and days tend to try to do things that it did the prior day or do the opposite. Yesterday we rallied, reversed on 31. Today we're rallying and reversing 29, but I still think minor reversal, not worth shorting. For the bulls, another high one, 29, but they barely made a 5-point scalp, 26. So that will reduce the number of bulls buying above 29. At this point, I'm scalping because I think we're forming an upper trading range. I did buy 26. I'm not going to buy 29. I'm going to wait. High one, but bear bar. Probably trading range soon. Sellers probably above 29, probably above 27. And for the bulls, I would wait. I think we're probably going to convert into a trading range. I would wait. I think we're probably going to convert into a trading range. If I'm going to be paying far above average price, I want bars to be far above average. Consecutive bear bars, bear bar 29, that is not far above average bullishness. So I don't want to pay that much above the average price for that. The bars are getting smaller. We're starting to get reversals again, probably early in the trading range. It's possible that 27 is the high. I suspect we'll go a little bit higher at some point. Can we get all the way back down here? Probably not. It's probably going to remain in a trading range for the remainder of the day. So down to the 26 low, maybe the breakout point, 19 high, maybe the moving average. So the bottom of the range is probably going to be here. Top of the range might be here, might be a little bit higher, but probably trading range for the next several hours, the rest of the day. The bears were hoping it's a climactic buy climax, a failed breakout yesterday's high, and that will get a trend reversal. But just like I said, the reason a trading range is likely is we had a trading range here. That also reduces the chances of a bear trend reversal. It makes it likely that we had a trading range. Traders thought the price was too low. We quickly moved up, and now they think this is fair. So we're probably going to not get a bear trend reversal, at least not for a couple hours, and we're probably not going to go much higher. Bull's trying to get a high too, but we're starting to get smaller bars, bear bars. So not a very good buy above 30. Right now it's a micro double bottom, 29.31, neckline 30, so theoretically it's a buy above 31. I would not take it. We're getting average neutral price action, but we're far above the average price. And smart traders sense that this looks like it's starting to convert into a trading range, and they don't want to be buying at the top. Suppose, in fact, it does keep going up all day. Well, it's unlikely, but if it does, I'll try to take as many good stop entry buy signals as I can get. Right now, I'm not willing to buy above 31. We're starting to go sideways 25, and we're far above the moving average, so I want to buy lower. Trading range, you want to buy low, not buy high. And you want to sell high, but you want pretty good evidence that the market is in a trading range. I think we are, but I think there's no rush to sell. A second reversal down from above yesterday's high. We broke out above yesterday's high 27. We broke out above yesterday's high 30. Both breakouts failed. Tight bull channel 28, not a very good sell. And two dojis 30, not a very good stop entry sell. So right now, better to wait. Can you buy? Sure. Can you sell? Sure. Can you make money buying? Yes. Can you make money selling? Yes. How can that possibly be? Because we're probably in a trading range. So traders will look to buy more lower, and then scalp out, and they'll sell more higher and scalp out. Bears hoping for a bear trend reversal. They're hoping this is the high of the day, but it's probably a bear leg in a trading range. Just like I said, 24, 26, 27, probably a bull leg in a range. This is probably a bear leg in a range. We have a spike pullback in a parabolic channel. We could come all the way back down to the start of the channel, 15, but I think more likely this is the start of a trading range. Bulls giving up. The bulls who are suddenly deciding that, hey, maybe it's not going to go much above yesterday's high. It's a terrible buy signal bar on the daily chart. And it's a second reversal down. And for the bears, some bears are selling 31, but what are they going to do? They're going to scalp. Why are they going to scalp? Because it's selling the first reversal down in a tight bull channel, and the first reversal down is typically going to be minor, bear leg and a trading range. So we're probably in a trading range. Patiently wait to buy a reversal up from a sell-off, preferably above a bull bar closing near its high, preferably a second reversal up, a high 2, and patiently wait for it to get near the top and reverse down, and then sell and take quick profits, because we're probably not going to go far up or down. We could still get a trend reversal down, but we probably will have to go sideways for a lot of bars, 10 bars, 20 bars, before we can get a credible major trend reversal. More likely, traders will buy anything bearish, 31 close at the moving average, right? Test of the 19 high, and they'll scalp, and they'll sell when we're near the top. Remember when we were having this small pullback bull trend, I showed examples of bull trends that last all day, and I said they do not look like this. And I said, therefore, this would not last all day. I said the bears would try to get a reversal into a bear trend, but I said most likely it'll convert into a trading range, because that's what it typically does. And I said, you never know where the bottom will be or where the top will be, but you do know a trading range is likely. And we sold off, we tested the double top and that December 3rd low, and we had a little parabolic wedge here. Different ways to count it, but 1, 2, or 3. And then we rallied. We had a wedge here, 1, 2, 3, and a bull breakout. And whenever you're in a trading range and you get a breakout near the top, you always got to be thinking there's an increased chance of it being a trap. So you look for a reversal down 56, and you can sell it. But when the channel is tight like that, and with the day being in a trading range since 25, it's probably not going to go down all that far. So you can see it did not go down far. For the bulls, it's a high 2 at the moving average. But for bear bars, tail, nobody wants to buy above 60. The bears are hoping it's a double top, actually a lower high double top, but a lower high major trend reversal. When you have a tight channel like this and you get a reversal, it's probably going to be minor. The bottom of the range is here. Right now, there's a decent chance we're not going to break out of the range. We won't go above that. We won't go below this. We have an hour and a half left. It's possible we can break above, but I doubt we'll go much above. It's possible the bears will get their double top. We'll break below the neck line and get down to the low of the day. But I don't think we'll go down that far. So if we were to break below 38, probably not much below. I said that because we had a trading range for basically 23 bars, we broke out above it. We had a double top and a breakout, but the trading range behavior continued for 23 bars. I said that the rally, even though it's strong, 24, 26, 27, I said we're probably not going much higher before we convert into a trading range. It fell lower than I thought it would, but it's still a trading range. So a trading range here, a breakout, and a trading range here. It's the opposite of yesterday. So today we have a bull trending trading range, a trading range, a bull breakout, and an upper range. Yesterday we had a bear trending trading range. Today we had a trading range, a bear breakout, and then a lower range. And we had a slight breakout below the lower range at the end of the day. 60-minute chart, sideways now 5 days, maybe forming a triangle. 1, 2, if we pull back, then 3, breakout mode in a bull trend. Trading range in a bull trend more often will break to the upside than downside. But if the trading range starts to get a lot of bars, 20, 30, 40 bars, then the probability of a bear breakout gets almost as high as the probability of a bull breakout. Right now, it's still more likely we'll go up. Back to the 5-minute chart. What do you do here? The market's not going to move much. Since bar 48, it's been a tight trading range. And therefore, stop entry traders are losing money. Right? They buy the close of 55, they sell below 56. They buy above 57, they sell below 58, they buy above 60. You don't trade that. You wait. When the market looks like this, what you do is nothing. That's the absolute best thing you can do. If you get to be an experienced trader, you can do limit order scalping, but most traders should just sit back and wait until we have evidence of a trend. We're on a sell signal below 56, a second sell below 58, but a tight bull channel and big up, big down, now big up again, probably a trading range and a minor reversal down. So if you had to be anything, I'd be short below 56 or 58. But chances are this is not going to be the start of a bear trend. Market often has a lot of wedge type of legs. Here you can call it a wedge here, 52, a bull breakout that failed. Here we had a parabolic wedge going down. We had a wedge. Now we have a mini wedge, 3 legs down, 57, 59, 62. And to buy, the bulls will need a pretty good bull bar. But even then, the bulls buying are hoping that we get a really big upside breakout. They know we probably will not get it. So what will happen is they buy, and they'll be very quick to get out if it does not race up. And they know it probably will not race up. And that's the opposite of bear selling as it's going down. A low one below 58, a low one below 60. The bears are hoping for a collapse, a big bear surprise, but they know they're probably not going to get it. And when they do not get a really big bear surprise bar, they decide it's not what they want, and they try to get out around break even. The better, let's say 62 is a bull bar, the better it is, the bigger it is, the more it closes on its high, the more bulls will buy. But it's probably a minor reversal, so it's probably not going to go very far. Now, right from the outset of the day, we kept getting all these big bars, and they kept reversing. And it's a warning that traders do not believe the market is going to go very far. Anything bullish, they sell. Anything bearish, they buy. So we may not get any other strong stop entry trades today. The bulls are trying to get a double bottom 49, a wedge 57, 59. And if they get a bull bar closing near its high, closing around the moving average, traders will buy it. But if it doesn't race up, they're going to exit quickly. It's probably not going to race up. So anybody buying with a stop has to be prepared to make very quick decisions. This is limit order trading. You buy below stuff, you buy more lower. And the legs, the height of the range is relatively small. The bars are getting small. So you're not scaling in 5 points, 10 points lower. You're scaling in, 1 or 2 points lower. And you're not going for 5-point profit anymore. Now you're going for 2-point profit, 3-point profit. So it's really not very good. And I think most traders should just wait. Okay, this is what I was saying. If the bulls can get a big enough bull bar closing on its high, it will attract buyers. Okay, so that is a reasonable buy. The problem the bulls have is it's within a very tight bear channel. The close, I always pay attention when you get these bull buy signal bars at the moving average. I always pay attention. Is the close at or above the moving average, or is it below? And if it's at or above, I'm more inclined to take the buy. If it's below, even slightly below like this, I usually do not take the buy. So I did not buy about 62, even though double bottom 49, wedge, still always in long, but a very tight bear channel, and the close below the moving average. Can you sell below 62, below 63? I would not. Probably more buyers below. If we break below 62, isn't that a breakout below a wedge? It is. And 55 was a breakout above a wedge. We have a wedge, 1, 2, 3, breakout above. Most breakouts fail when you have a lot of trading range trading. So if we break below 62, it's more likely that there'll be buyers below than sellers. Do I get upset when there are not a lot of stop entry trades? I never get upset. Sundays are trending days, and you have a lot of stop entry trades. Other days are much more trading range days, like today. You have very few, and I don't worry about it. I tend to take more limit order trades on a day like this, but I just don't worry about it. There's nothing I can do to change it, and the market is just going to do every possible thing at one time or another. So anything you can imagine, no matter how unlikely, the market's going to do it at some point. And nobody has any control over it. So you got to trade what is in front of you. The more the market is trending, the easier it is to trade. You just keep buying. If it's trending up, you buy above bull bars closing near their highs, and you don't worry about it. The more it's like today, with bad follow through, a lot of reversals, very few good stop entry setups for the bulls or the bears, there's just not much to do. And, don't worry about it. Just accept it. Just look at it and say, yeah, it's not my style. I can't make money trading this. And my goal is to make money. The most important way to achieve that goal is to avoid stupid things. And taking bad trades is doing something stupid. And what happens is, on the trend days, you do the right stuff. You enter with stops, you get a few swings, you make decent money. And then on a day like this, you force it and you try to do the same thing, but the environment is not the same. And the way to trade this is not the same as the way you trade a trend day. And therefore, it's better to wait than to take trades that you hope become trends, and then when it's clear they're not becoming a trend, you continue to hope and you don't exit, and you end up losing money. And the result is you erase all the good stuff. And I talk about this regularly. One of the most important things that a trader has to do to become consistently profitable is to get rid of the bad trades. And that means don't take them. Or if you take a bad trade, you get out right away, right? Because, they erase all your good stuff. If you're doing good stuff, that's good. You want to keep doing the good stuff, but you got to get rid of the bad stuff, because the bad stuff is what keeps you from making a living as a trader. So when you look at this, your radar should be making all kinds of noise telling you danger, 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 right? Don't trade this. Very hard to make money doing this. It's easy to make money if you're a limit order scalper. You just buy below everything, you buy more lower, and you scalp. You sell above everything, you sell more higher, you scalp. Anything that looks bullish, you sell. Anything that looks bearish, you buy. But most traders do not have the personality to do that. And most traders, to do it, you have to use wide stops and you have to be willing to scale in. And that is where people just get killed. Let's say you sold with a limit order at the double top, 16 high. What do you do when you see that, right? If you're smart and lucky, you get out around break even once you get that big pullback. But otherwise, you hold, wait for a bear bar closing in a slow, and you sell more, either below 25 or the second leg up 28. And you hope it gets back to your original price so you can get out break even on your first sell and with a profit on your higher sells. And it's hard to do when the market is going up strongly like this. It's hard to be holding short. But when it was doing it, what did I say? I said, it's not going to last. It's going to turn into a trading range. And so for me, I did not sell the 16 high, but if I did and if I held, I would have been at peace because I know it was going to turn into a trading range. And I just wait for a bear bar, especially the second leg up, and sell below, and confident it would get back to the midpoint of my two sells. So a bear who sold at the 8 high, he got filled here. He waits for a bear bar closing near its low, like here or here. That's a bull surprise. I wait for a second sell, so I sell more below that. And 80% chance it's going to come down to my average price, and I'll be able to exit break even. I'll lose that much on the first short. I'll make this much on the second short, and you can see what happened at the midpoint. It hesitated because a lot of the bears bought back shorts. And then ultimately we get down below the first entry price. So the bears who held could exit break even here and make a pretty good profit on their sells below any or all of these bear bars. But hard to do. It's hard to be short. And you say, oh my gosh, 24. Oh no, 26, 27, two bull bars closing the other highs. I'm going to lose all my money. No. And one of the reasons that traders lose money scaling into, like when the market's going against them, is they don't do what they need to do. And you know what you need to do? Whatever position size you have, and you get that second signal, you double your position size, right? You don't panic out on the close of 27, say, oh, I can't take the pain. That means you're trading too big. You have to be trading the I don't care size. So if you lose, you don't care, right? And you got to be able, if you're using wise stops and scaling in, you have to have the ability to double your position size. So whatever size you are, let's say you sold 3 E-minis here, then you have to be willing to sell 3 more here or 3 more here. Otherwise, the strategy is not going to work. And sometimes I'll sell twice as much. So let's say I sold 1 micro E-mini here, and I decided the rally is going to be a trading range, and I'll just wait for bear bars and I'll sell below them. I might sell a second one here and a third one here. So I've tripled my position. Or I might not take this one and sell 2 here, and I'll triple my position. And it's difficult to do. So what do the bulls who bought above 62 do? They're saying, darn, Al said don't do it. And now we're getting the bear breakout. It's the opposite of 55. A bull breakout above a wedge, we're getting a bear breakout below a wedge. The bears want a measure move down, but it's a trading range. And therefore, it's more likely that we're not going to reach the measure move down. Measure move down gets us below 38, the neckline of this double top. But more likely, anytime it goes below something, there'll be buyers. It's below something. It's below 62. So there are bulls with limit orders buying the 62 low and then buying more lower, maybe 2 points lower, maybe 5 points lower, betting that they'll make a scalp. Why did we fall below 62? Is it bear shorting? No, it's bulls not buying. It was a dumb buy above 62. Not many bulls bought it, so it did not form a bull bar. And then the bulls who did buy panicked, and some of them got out below 63, and others said, well, I'll just get out below 62. And there are other bulls wanting to buy 62 or below, so they're not going to buy 63, the bear bar and the failed wedge bottom, but they are going to buy below 62. So once it gets below 63, it has to go below 62 because that's where the buyers are. So the traders with stops below 62 are going to get stopped out. So bulls bought 62 low, they'll buy more lower, and they might scalp out for 2 points. They may hold, hoping for a swing up. And for the bears, some bears sold below 56 or 58. Some sold below 63, but they have to be disappointed. 64 tail, 64 closed below 62, good for the bears, but it's a trading range day, and we're fairly far down from the high, so not a good location to initiate shorts. We're in the middle of the trading range, a reasonable location to take profits on shorts if you sold near the top. I said it's better to enter with stops. Can you buy above 64? No, don't buy above 64. It's 2 bear bars. You get bulls buying 62 low, buying more 2 points lower, and they're scalping out once they get 2 points, 4 points, 5 points. So it's limit order trading. Can you sell the 64 high? I think it's similar to buying the 56 low. We reversed down from above a wedge, and you don't want to buy right away. And now we're reversing up from below a wedge, and you don't want to sell right away. What do? Well, if you were a smart bull and you bought the 62 low and or 2 points lower, you exit and you wait for the next trade. And if you're a bear, basic rule, the bars are relatively small. I'd get out a couple points above any bear bar 64. The neckline of the double bottom, 62, 64, I'd get out above the neckline, the 63 high. But I would not have taken the short. Bears want double top 62, double top 61, 58. They want some kind of a double top. And the bulls are hoping it's a higher low in a bull channel, and that we ultimately get a successful breakout above yesterday's high. Remember, yesterday's a high one buy signal bar, daily chart, but it's a bear bar, a pretty good sized bear body. It's a bad buy signal bar, so I said there would be sellers above. We've been above yesterday's high twice, went above it, sold off, went above it, sold off. We did not sell off as far this time. Really not good trading here since 25. That's what we have, trading range. The bears have a double top, the bulls have a higher low double bottom, maybe forming a triangle. If we get a lower high here, then we'll have 3 tops and 2 lows. It'll be a triangle. But that doesn't change things. We're already in breakout mode. On that reversal down here, we got a 50% bounce. So there's the low, there's the high. So we went down, bounced 50%, and we may get a 50% bounce here as well. That's the first leg up, that's 50%. So there probably will be limit order bulls right around there. Bears double top 61. Other computers double top 63. But a failed breakout below a wedge climax that reversed up. We should get at least a couple small legs sideways to up, and that lowers the probability for bears selling below 66. Not by the close. The bears want a reversal down, a triangle, 3 highs, 27, 57, 50, 55, I mean. Are we always in long or short? I think we were briefly always in short 37, but I said that a trading range was likely and therefore it's not sell the close. But beyond that, I think we've been always in long all day, and I think we're still always in long despite all these bear bars. We're basically holding above the moving average, and that's making the moving average go up. The bears double top 61, but 2 bull bars. Not many bears will sell below 66 or 67, especially if it were a bear trend. 40% chance a bear bar 67 would lead to a breakout below 64 and a measure move down. But this is a trading range, a triangle, possibly a triangle if we get a reversal on 67. Breakout mode, but more likely it'll be like what I said earlier today, in here and in here. I said probably a trading range for the remainder of the day. So you have a sell signal, you have a buy signal, a sell signal, a buy signal, but you end up going sideways, and that's still probably what we'll have for the remainder of the day. And right now we're in the middle of it, which is the worst location to enter. You want to be buying low, so you don't want to be buying in the middle. You want to be selling high. You don't want to be selling in the middle. Suppose this is the start of a bear trend down to the open of the day. If it is, it'll become more obvious. We'll get 2 or 3 bear bars, then sell. There may not be as much profit remaining, but the probability that you'll make money will be greater. So if you see that, yeah, it's overdone. We're probably going to get a pullback, but it's higher probability to either sell it or sell rallies below bear bars, below that, below this, and hope for a second leg down. If you see this, you buy it. Chances are you're going to get a second leg up before you go below this low. If you see that, you sell it. Chances are you're going to get a second leg down before you go above the top of it. Yeah, a small second leg here, another small second leg here, a reasonable buy there. But I would keep looking to sell. We have a wedge, 1, 2, 3. I would sell that. A double top, a bear bar closing near its low. I would sell that. Double top, 61, 66. Traders bought it. Everything is small now. I don't know if you remember a month or so ago, a lot of the days were 100 points tall, the range, and a lot of the bars were 20 points or more. Some bars were 40 or 50 points in 5 minutes. And I said, that's not going to last. The daily bars and the 5-minute bars will get smaller. And that's what has happened. For the bulls, they're hoping 65 is the start of a rally to a new high, and 67 is a pullback, so 67 is a high one, but you're buying too high up in the trading range. So I think better not to buy it. And for the bears, they're hoping this is a double top pullback. We have a double top 27.55 and a pullback, and they want to sell it for a swing down. But terrible environment for swing traders, especially when you just look at the day from across the room. It's all sideways and very prominent tails all over the place. Every tail is a reversal, the market going one way and then the opposite way. That is bad for traders who are hoping for a trend. They're hoping it just keeps going one way. 66, a multiple of 3. It corresponds to a close on the 15-minute chart. So for the bulls, we're rallying, we pull back, and we're pulling back again. It's a buy. But look at this, tight trading range for 9 bars now. Really bad for stop entry trading. You cannot just look at the buy signal bar. You got to look at the context. Context means the bars to the left. And we're sideways. Traders selling above, buying below. So not a very good buy above this bull bar. Back to the 5-minute chart. Bulls want a breakout above the double top, and they're hoping we rally for a measured move. Bears want a reversal down from a triangle or from a failed breakout above the double top. Always in long, but not a very good buy above 65 or 67. Hard to trade. Everybody is hoping that we get a trend, and nobody cares if it's up or down. You just want a trend, but you want evidence of a trend. We do not have a good buy signal bar 64, do not have a good buy signal bar 67. And if you're hoping for a trend, that means you're less confident that this is the start of a trend. If we get a pair of bars closing on their highs, 68, 69, then it could become buy the close. Well, we had a big bull bar 55. What happened? Sold off. We had 2 big bull bars 27. What happened? Sold off. So we're probably not going to get a strong trend, but the more we get big bull bars closing on their highs, consecutive big bull bars closing on their highs, the more bulls will buy and take a chance that we're going to get a successful bull breakout of the upper trading range. Yesterday we had a bear breakout of the lower trading range. So trading range, bear breakout, and then lower trading range. And at the end of the day, we had a couple bars breaking out. Too late in the day to expect much profit potential. This is earlier, so the bulls have a chance of a significant profit, but the chance is small. It's a low probability bet. Now, do you buy or sell the close 68? Well, what happened with bull closes around here earlier? More sellers, more sellers. Getting late in the day to be selling with limit orders after big bull bars, or buying with limit orders after big bear bars. So it's better either to trade with the trend or wait. And to me, it's not convincing enough for me to buy above 68. If 69 looks like 24, I think that will attract buyers. If 69 looks like 28, it'll attract sellers betting on a triangle reversal down. If 69 looks like 52 or 29, traders will wait. Unclear. They want clarity. They want something very bullish or something very bearish. And anything else, they're not going to trade, or at least stop order traders will not trade. Whenever you're waiting and waiting and waiting for information, that's a sign the trend is not strong. And everybody's waiting to see if 69 will have a bull body or a bear body. Will it have a big bull body or a small bull body? Will it have a big bear body? And we're waiting. And that automatically tells us that it's not going to be strong follow through, and that reduces the chances that this is going to go a lot higher. For the bulls right now, it's an inside bar, a high one. For the bears, it's a triangle, 3 highs, lower highs, and higher low. But good enough bull surprise. The bears would need a very good bear bar, 69, to sell, and they did not get it. For the bulls, a high one. The bulls who bought the 27 close or the 55 close, if they're still long, they can get out break even. And that's part of the reason why we're going sideways. A lot of those bulls are selling. And the bulls hoping for a trend need bulls to be buying. And we're not getting a lot of aggressive buying here. High one for the bears, a triangle, 2 lower highs and a higher low, but 2 bull bars. So do not sell below 69. Bulls who are long, they can get out a couple points below 69. They can get a tick below a bear bar. And the traders who are flat or who are interested in taking a chance we rally and go up for a measured move, it's a buy above 69, but only for a swing. Chances are we're going to remain in a trading range, even though we're trying to break out. We're trying to break out at 27, 55, and now again 68. So if you buy above 69, you're hoping that 70 will look like 68. It will race up quickly. You know it probably will not, but you're buying hoping that we get a breakout like 24. That makes the management tricky. You have to be prepared to exit quickly if you do not get what you want. What happens if we continue to have an II? Right now we have an inside bar 69, another inside bar 70. Traders will sell below, they'll buy above. We're always in long, so it's slightly more likely we'll go higher. But because of all the trading range trading and the lack of follow through up or down, we're probably not going to go a lot higher. So that triggers the high one buy. But if the bulls do not get a pretty good bar, they will exit. If you buy 69, you're not buying for a 2-point scalp. The probability is not worth it. You know, you're risking 10 ticks to make 8 ticks. So you need to be 80% certain to make it worthwhile. This is not 80% certain that it will go up 10 ticks before down 8 ticks. Good bar for the bulls, closing on its high. So that makes a lot of traders just hit by the market. No significant nearby resistance before we get to those targets. You know, this is the high from 2 days ago right there. But 60-minute chart. The important price is, which is where the market is going. Again, I don't know if we get there before we get more of a pullback, but that's where the market is going. We're going up to this high. Is there anything to short here? No, you either buy or you wait. Might be a little bit of a spike in parabolic channel, but there's really nothing to short. Whenever you get a spike and then the bar is getting bigger, 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 and then smaller. On a small time frame chart, this is almost always a parabolic wedge, even though on the 5-minute chart, it might not look like it. Bears want a reversal, but with 4 or 5 bull bars, most traders are not going to short below 72. Bulls, I'd get out a tick below a bear bar. I'd get out a point or 2 below a bull bar. And for the bears, they'll probably need a micro double top or some kind of a second reversal down, like 25, 28. Spike, parabolic wedge. The tail, that'll reduce the number of bulls buying the close. I'd get out a point or 2 below any bar 72. And for the bulls, There's probably not much more to this because of the parabolic curve. Parabolic means if you draw connections, lines to the highs, they get steeper, and now we're getting smaller bars and it's getting flatter. So it's kind of like an S that goes up steeply and then curls over. Can you buy the 72 low after 5 bull bars? A computer will do it. Individual, I would not. I would wait to see if we get a high one with a bull bar. Difficult to do anything. Reasonable to exit longs, but I don't think it's worth shorting. We have a spike, pause, and then parabolic channel. So it's possible we'll come down here, moving average, yesterday's high and the double top. And we're running out of time to get a trade. The bulls do not want to buy above a bear bar 73, and for the bears, it's probably a minor reversal. Bad sell signal bar 72, 73. You can see it's really difficult to do anything here. Not much time left. Pretty good rally. The bars are not all that big, so not much profit potential for the bears. The bulls want a high 175, but after 2 bear bars, we're probably not going up very much. They're hoping 75 is a pullback to the double top, just like we had a double top here and a pullback and a rally. So we're probably not going to get any more trades today. There's the high 1, a breakout test of the double top. But after the 2 bear bars, I think it's not a very good buy. You know, traders buying it are hoping we get a bull surprise 68, but they know we probably will not. So it's a low probability bet. You need big reward to offset the low probability. Not much time left to get big reward. So I would wait for tomorrow. Bulls, if they bought, I would get out around break even at this late in the day. You know, you want it to go straight up, and if it starts to fail, you quickly take profits and you use a very tight stop, like around break even. The reason for that is at the end of the day, sometimes you can get stuff like this. You know, it looks very bullish, and then you get that. And all the bulls who bought in here end up quickly losing money, thinking they were buying a buy the close rally. That red line is Tuesday's high, which is the high of the week. Tomorrow's Friday, and the bulls want the week to be a bull bar. Last week we had a big bull bar, and the bulls are hoping we're resuming up, so they'd like to get this, a series of bull bars. Or if there are bars that are not bull bars, they want a small pullback bull trend. We're going to the February 2nd high. That's the next place where the market will make a decision. Will we get a reversal down from a double top, or will we get 2 closes above it and then a new all-time high? I've been saying since this low that we've either seen the low of the year or at least the low of the next few months. When we had the strong selling here, I said, you know, maybe it's 50-50. But then when we had this one day here, I said it's back to 60%. We have a double bottom, higher low, and 2 very strong reversals up. And we've rallied strongly here. And this is the test area. So we don't necessarily have to reach it. We can turn down below it like this. We can go a little bit above it and turn down. But that's where we're headed probably in the next week or so. It's possible that we pull back below this breakout point and then go up for a third leg or a wedge, 1 pullback, 2. So it's possible 1 pullback, 2, and then pull back, and then 3, and go up there 3 or 4 weeks from now. But that's where the market's headed. Are we in a trading range? Are we going to fail there and have a bear leg? Are we in a bear trend? Are we going to fail there, break below this, and fall 500 points for a measure move down? Or are we in a bull trend? Either we break strongly above it, or we get to it, pull back, and then break strongly above it. As I said, there's still a 30% chance we break below this, and I think if we do break below this, there'll be a 50-50 chance of a collapse. So 70% chance we're either still in a trading range, which we are, or the bull trend is resuming, which it is. So it's both right now, the resumption of the bull trend and a bull leg in a trading range. And it's still also a bull leg in a bear trend. You know, it's still possible we double top here, but 70% chance we're either going to stay sideways for several months or we're going up here. The character of the day changed over here, 68, 69. We started to get less overlap and more bars closing near their highs. I debated buying 75, 76. I normally would buy above 76, and today I did not. I guess I'm just bored from all of this, and I didn't want to give anything back. On a day like this, I do not make what I make on other days. You know, I made money, but not very much money. And so I'm resistant to risking any of it at the end of the day, and I ended up not taking the buy. Yesterday we were in a bear channel, bull flag, 75% chance we eventually break above the bear channel, which we did. We had that collapse on the open, on the close yesterday, and then a gap up. So the gap up is reversal, big down, big up. The bears hoped that one was a double top 76 and that the bear trend would resume. The bulls hoped that one was a pullback from the gap up to the top of yesterday's trading range and the breakout above the two moving averages, which it turned out to be. In general, if you have on the open or early in the day, two bear bars, one of them big and closing near its low, the market is a sell to close bear trend. And I said, in this particular case, I would not do it. I would not sell the close of two because this is a reversal down and up, and this could be a 50% pullback and a test of that high from last week. So I thought it was not good enough to sell at the two moving averages, flat moving averages at the bottom of yesterday's range. And then three, not a good buy either. For the bulls, it's a high one. A gap up, a bull trend, a 50% pullback, and a high one. But a bear bar, so not a good buy. Three broke above one, so the bears gave up. But the bulls could not close above one. So it's not yet a strong buy. And then four is a bear bar, bear inside bar. So for the bears, it's a micro double top 1, a double top 64. But a bull surprise 3 will probably get a second leg sideways 2 up, especially with the tail on the bottom of 4. So probably more buyers than sellers below 4. But we might dip below the 2 high first. And 5 turned up from above the 2 high, and I mentioned that it was a sign of strong bulls. The bears were desperate to get back to the 2 high, to get out without a loss, and instead we reversed up from just above the 2 high. So the bears who sold the 2 high used a wide stop and scaled in. They gave up on 5. IOI, bear inside bar 6. Credible short, possible high of the day. A micro wedge 1, 3, and 5. Close on the low. And I mentioned that it was important that 7 did not go below 6 to trigger the sell. That meant here we had a good sell for the bears below 6, a good sell signal bar micro wedge, the top of the trading range. Yet the bears could not get the market to go 1 tick below 6. How is that possible? Because the bulls bought the close of 6 and they had limit orders to buy at the 6 low and just above. And there were more bulls buying than bears selling. So we got that bull surprise 7, a breakout above the wedge 5. And bull follow through 8. I said that we have a gap, 8 low, 5 high. We have a body gap, that body of 8 and the breakout point 5. But tail 8, small bull body, and tail on the top of 7, not a strong breakout. For the bears, it's a wedge, 1, 5, 7, a higher high double top 64, a failure at that December 3rd low. But I thought enough of a bull surprise, 7, follow through 8, probably a minor reversal down. We broke below the bottom of 7 and below 6 with bar 10, and now we have consecutive bear bars with at least one being big and closing near its low 10, but close above the moving average, close above both moving averages. So bad for the bulls, but not all that good for the bears. The bears need to get a break below the moving average, which they got 12. But I always talk about how I want to see, for a bear breakout, I want to see 2 consecutive bear bars with closes near their lows and below the average, like 36, 37. I'll talk about that in a minute. But here, the bears were unable, and it made me think that it could be a double bottom 5, a double bottom higher low. Not a good buy signal bar, 12 after 4 bear bars, but bull surprise 13. Bad follow through 14. Now the bears have a lower high double top, 14, 8, but bull surprise 13. We should get at least a small second leg up. So I would not sell below 14, but it's not a great buy. We might dip below the 12 high, the bad buy signal bar high, and we did not. 15 did not go below 12. So it's similar to 5 not going below the high of 2. The bulls have a high 115, but it's at the top of a developing trading range, so not a very good buy. They have an entry bar 16, not that big, tail on top, a lower high 8. For the bears, a lower high double top, but 2 bull bars, always in long. I'm not selling below 16 or 17. For the bulls, a high 1 above 18, double bottom 15, but 2 bear bars, top of a trading range, I'm not going to buy. The bears will give up if it goes above 8, the double top. And they did. We got a breakout far above 8, but I talked about how the close of 19 was below the double top. So not very good for the bulls. Also, 20, the follow-through bar had a bear body. So for the bears, different ways to look at it as a wedge, 1, 8, 19, and then a micro wedge, 14, 16, 19. But I'm not selling below 20, a bear doji after a bull breakout 19, when we've only had one close below the moving average in 20 bars. So I'm not selling, but it's not a very good buy. Bulls got consecutive bull bars 21, 22, 21 closing near its high, 22 closing on its high. We're in a small pullback bull trend since 13, small pullback, small pullback. So it's okay to buy, stop maybe initially below 20. Entry bar 25, not good. And then bull surprise 24, a breakout, a bull breakout, a bull bar closing near its high and closing above the high of the prior bar 23, and preferably closing above some other high or the top of a lot of bars. And 23 closed above 21, the reversal, 19, the reversal, and they've closed at a new high of the day, so good for the bulls. Bull surprise, we should get at least a small second leg up. The bears got a bear bar closing near its low, 25, arguably a wedge, 16, 19, wedge, 8, 19, but we should get a second leg sideways to up. I suspect today's going to evolve into a trading range because everything that is happening is bad for the bulls and for the bears if they're looking for trends. So if nothing is right for a trend, it's probably a trading range. And since we've had trading range behavior for 23 bars, we had a double top here, a weak breakout, really more a continuation of the trading range behavior, 23. I think we're not going to go up very far, and then we'll convert into a trading range. It could be for a couple hours. It could last all day. But 26, a high 1, I'm not at all confident we're going to go up much. In fact, I'm confident we're not, and I'm confident we're going to enter a trading range. It could be very tight. It could be deep. We could get all the way down to the 15 low on the start of the spike pullback channel. The bears got a reversal, 28, parabolic wedge, 3 legs up, 19, 25, bear bar closing near its low. That's yesterday's high, failed breakout above yesterday's high. A really tight bull channel, probably a minor reversal, which means either it's going to be a bull flag, we have a high one, bull flag 29, or it's going to be a bear leg and what will become a trading range. And that's what it ended up being. Bad high one, 29, probably sellers above for a second leg down. 30, a second reversal down from above yesterday's high. So we'll probably go at least a little bit lower. Maybe we'll test the double top, which we did. And then we got a pretty big bear bar 31 and followed through 32. So we're probably going a little bit lower, but we have not been down to the moving average in about 20 bars. There will be some bulls buying at or around the moving average. Micro double bottom 34, but tight bear channel and only one small bull bar in the past 7 bars, 31. Probably sellers above 34. And then a low one, 35. The bears have what is right now a small pullback bear trend, but I think it's a bear leg in a trading range, and I think it's the opposite of 26. I said we're probably not going up much above 26. We're probably not going down much below 35. 36, 37, consecutive bear bars with decent bodies. 37 closing near its low. The body of 37 completely below the moving average. So it's technically a sell to close breakout, but we're still probably in a trading range, and the sell-off has had weak follow-through. I don't think we're going to go down. In fact, even though technically it's sell to close, it might be more buy the close. We're at the bottom of a developing trading range. Bulls outside up 38, parabolic wedge 29, 32, but 3 bear bars, 4 bear bars, probably a minor reversal. Bears, I'd get out of shorts above 38. Bulls, they could buy, but it's probably not going up all that much. It went up fairly far, but it was sideways for the next couple of hours. So up and then back down to the 37 high. Bad buy signal bar 37. It got tested 40. It got tested again 64. So really difficult for stop entry traders. You could buy above 38, 39, 41, 42. But what do you do when you get 43? A lower high major trend reversal, outside down bear bar closing near its low. Micro wedge 38, 41. Probably good to get out below 43. Bull bar closing near its high, 45, 46, but by the close, you're at the top of the trading range, so not very good. Bears tried to get another reversal down, 48, just below yesterday's high. A little bit of a wedge, 3 legs up, 38, 43, 48, but small pullback bull trend, bull bar, 3 of the past 4 bars, bull bars, just above the moving average, probably buyers below 48. High one, inside bar 50, a tail at the top of what is probably a trading range, not very good. The bears trying to get a reversal 53, a wedge 43, 48, 53, but a small pullback bull trend and a small sell signal bar, I think a minor reversal. High one 54, and we broke above it. And I said that we're breaking above a wedge, normally 50-50, that it'll be successful, 50-50, that it will reverse. And I said the probability was higher for the bears because we're in a trading range. Look to the left. This could be a buy vacuum test of that high. The buy the close bulls 27, disappointed 28, could never get out without a loss. It never came back to that 27 close. And this is their opportunity. So 55, a lot of the bulls who bought 27 are going to sell. And that's what happened. There were more traders selling the close of 55 than buying. We got reversal down 58, closed near its low, did not completely reverse 55, but it's still a failed breakout above the wedge and a double top, a slightly lower high double top major trend reversal. I think you can sell below 58, but I think we're not going down far. 50s, you can sell below 56, but not going down far. 57, a high one, but we should get a second leg down after the reversal down from the breakout above the wedge. 58, a second reversal down from yesterday's high, 56, 58, but small bars, 57, 58, probably not going down far. For the bulls, a high 260, but a tight channel. Tail, I wouldn't buy it. 62, a wedge, a tight channel. A small bull bar, closed below the moving average, and I said I would not buy it. 63, double top 61, a failed wedge bull flag, but I'm not going to sell it. It's a small bear bar, and we're in the bottom half of a trading range. And I said, I thought there might be more buyers than sellers below 62. Just like we had a wedge top 52, there were more sellers than buyers above. We have a wedge bottom 62, might be more buyers than sellers below. We reversed up 65, like we reversed down 56. But tail, not all that big. 66, double top 63, double top 61. But two bull bars, both closing above the moving average, probably buyers below 66. And then the bulls, a high one, 67. They're hoping this is the start of a bull trend and a breakout above the high of the day, or a bear bar. Bull surprise 68, good for the bulls. Inside follow through 69. It might be by the close. I think you can buy and hope that it rallies quickly, but if it does not, I would get out. 70, 71, closing on the high. 71, getting bigger, accelerating up. So possible wedge 65, 68, and then possible wedge 68, and then a parabolic rally 68, and then first leg up 71, and then there might be on a smaller time frame chart. This is almost always going to be a wedge 1, and some maybe the close of 2, a pause, and then 3. But I'm not going to sell on the 5-minute chart after 5 bull bars in a small pullback bull trend. 74 closing on its low. I'm not going to sell. We're right above the moving average in a tight bull channel, probably a minor reversal. And then 75, 76, a high one closing on its high. You can take a chance. I suspect we'll be not going up all that far. The bulls did get 10 points though, so it turned out to be good for the bulls. So stop entry trades today. Most of the day was sideways. You could say, well, Al, it's not sideways. It rallied from here to here. It was up all day. It was, but the way it went up was mostly sideways. Sideways here, and then a breakout, and then sideways here, and then a breakout. And all of that sideways trading is bad for traders looking for stop entry trades. The first reasonable stop entry trade was selling below 6, but it did not trigger. We did not go below 6. And then the next trade after that was buying above 15 or buying above 21 or 22. 26, I said a third leg up, and I think we're going to enter a trading range. So if you buy above 26, you're going to make quick decisions. If you did not scalp out 27, not all that big, then I think you have to get out below 28 because bulls will give up. And bears might sell 28. They're more interested in a second reversal down 30, but it's only a doji. So you can sell below 28 or 30 or below 31 or 32 or below 35, but I think it's probably a bear leg in a trading range. Bulls, they could buy above 38 or 39, maybe 41, 42, 45, 46. And then we're getting near the top of the range with small bodies, so I would not take those soft order buys. Bears, they could sell below 58 or below, 56 or 58. Bulls, 62, I would not buy it. 63, I would not sell it. Reversal of 65, not looking great, but we might go up. I think higher probability to buy above 71 or 72. 73 if you bought it with that tail 72. If you bought above 71, tail 72, smaller body, parabolic wedge. A lot of bulls will get out at the market. Otherwise, you can get out a couple points below or a tick below the bear bar 73 or 74. If you're trading always in, you buy again 75, 76. Limit orders, everything was limit order trading today. In terms of the easiest limit orders to trade, let me see, maybe buying the 11 low, not great. Buying the 14 low, I was pretty confident that we were going to get a second leg up, but it's a big bear bar, so that's not great. Same with buying the 25 low. You'll get bulls exiting. I would not do that. Selling the 29 high, I thought was good. Selling the 34 high was good. Buying the 39 low, 42 low. But if you bought the 42 low, you scalped out. And then in here, you buy below 48 or near the top of the range, not great. You sell above 54. I would not. I'd wait to see what we get. Sell above 57. Probably buy below 62. But better to buy with a stop on the reversal up. Buy below 66. And then this, I would not buy below 72. because it's too much risk late in the day that we could get a sharp reversal down. Then you had limit order bears selling above stuff, selling above 1, selling above 5, selling above 9, getting out break even here. I would not sell above 19. You could scale in above 25, but I'd rather not. It's a small pullback bull trend. And then buying below stuff on the way down. Maybe buying below 33. Over here, buying below 57, 59, 62. So difficult to make a lot of money. You can always do the Forrest Gump trade and take a buy 15, put a stop below 15 or 12, go to Walmart and come back at the end of the day and say, boy, what a smart trader. Well, the reality is it was a fairly broad bullish channel, a trending trading range day with a bear breakout at the end. And with all of the reversals and all the bear bars, it makes it very difficult to just buy and hold. So I tend to buy scalp, sell scalp, sell scalp, and just try to get as many pieces as I can. Question, did you sell below 28? I did not. I sold during 31. Did you buy above 62? No, I specifically said I would not buy above 62. I did buy on 60, toward the end of 64, maybe the start of 65, because I thought there was more likely going to be buyers below 62. How should a trader manage those trades? Selling below 28. If you sell below 28, I would put a stop above the wedge 27, or I would use a wide stop up here. And if we get a bear bar closing above 27, then exit above, if we get a bull bar closing above 27, then exit maybe above that bull bar before the stop gets hit. And then what would you do if you bought above 62? First of all, I would not. If I did, I probably would have gotten out below 63. But the alternative was put a stop below 38 and buy more at the 62 low, betting at best the bears would have a 50-50 chance. They probably will have less than a 50-50 chance given the context, bottom half of a trading range. So had I bought above 62, I might have bought more below, but it's only a couple points, 3 points different. So I'd rather be buying, if I'm scaling in, I'd rather be buying more below my first entry. Okay, I want to talk about how you scan the market for stocks and ETFs and monitor them and execute trades. I'm going to open let me turn off the screen for a moment. And let me see if I can find, you're probably not going to be happy with what I'm going to show. Okay, I have a screen with a whole bunch of stuff that I follow, best of breed, the stocks that I pay most attention to, all the obvious ones in all the different sectors. And then you scroll down, and I go through all the different sectors. And then below that, after this block, I go through the sectors again, and I put in even minor stocks in the different sectors. So semis in the Apple supply chain, and then software. It's all the companies that you'd expect, all the big companies. And then down further, I have ETFs and ETF subsectors. But look at, this is what I wanted to point out over here on the left. What do you see? This is row 1067, right? So you keep going down, and we're down to row 1300. So there are 1300 stocks there. And I do not look at 1300 stocks every day. But I do look at a lot of them, especially when the stock market in the E-mini is at a key price. So for example, on the daily chart of the E-mini, when we're pretty low, and I think the market might reverse up, and then we start to get a reversal, like on this day, I will take a look at a whole bunch of stocks, and I'll buy many, and that's what I did. I bought a collection of stocks on that day, and I'm back to flat. I think I get out on Monday or something, somewhere in there. I'm back to flat, even though the market looks like it's going higher. But I'm a trader, and I made a lot of money on the trade. I'm currently flat. I'm hoping that we pull back below this high and then reverse up again, and I'll buy again for another trade up. Or if we get up here and get a credible reversal down, I would need a pretty good reversal down and then trade that. So, for buying stocks and ETFs, I look at the E-mini, and if it looks like the E-mini could be reversing, sometimes I'll just buy E-minis and hold overnight. More likely, I'll buy stocks or leveraged stocks like the SPXL is a levered version of the spider. So, this is like a 25% rally, even though the spider is like a 7 or 8% rally. So sometimes I'll do that, and then the other thing I'll do is when I'm looking at that basket of stocks, if I see something interesting, if I'm not looking at the E-mini and I start to see this, I'm inclined to buy that or buy calls and betting that will go higher. 1, 2, 3, 4 bull bars closing near their highs. And so we're probably going higher, and that is Apple. So I'll look at individual stocks, especially the major stocks. Sometimes I'll buy stocks that are just way washed out. I mentioned last week that I had an order to buy Alibaba. I forgot what it was, but I wanted, at the close of this day, I wanted to buy Alibaba on the open of the next day. And it opened up here and sold off strongly on the open and then rallied. And it was too much of a distraction, and I just missed it. I miss trades all the time, both on the 5-minute chart and on the daily chart. I place a lot of orders that don't get filled. What else? What was another one? Twitter. I bought Twitter down here, a double bottom, higher low. And what else? So I'm just looking for special situations, patterns, oversold market. PayPal was one I wanted to buy, and I ended up not buying it. Down here, same thing, kind of a double bottom after a pretty good reversal up, and it rallied 15-20%. Other things I did buy. So sometimes I have a collection of stocks in my head that I know PayPal was doing this. I know it's way oversold. I know I want to buy it or trade. I look at the E-mini to see how if it looks like a buy. If it's buy, then a whole bunch of stocks will go up, and I'll buy stocks based on that, or I'll buy ETFs like the XPY or the XPXL, and then I also am aware of individual stocks, and I look for patterns and I look for trades. Let me say one other thing about Alibaba, the trade that I wanted to buy and I missed. Okay. Daily chart of Alibaba. Had I bought the close here and it rallied 30% here, I'm going to exit most or all. Because if I can make 30% on a major stock in one day, that is really unusual. And there probably are not a lot of buyers willing to buy after it just went up 30%. So I'd rather exit and then wait to buy more on a pullback. And I debated buying more on these pullbacks, but I did not. But if we come down here over the next few weeks, I might buy it. But there are so many stocks right now that are looking good that if you're not long, traders will look to buy a pullback. That's what I was saying on the daily chart, that E-mini, we might pull back below this breakout point, but if we do, I think there'll be buyers down here. I'm going to be out of the country. I'm going to London. I'm speaking in London April 2nd and April 3rd, and then I'm traveling after that for about a week. So I'm probably not going to take any trades. Sometimes when I'm traveling, I'll take trades, but in general, I don't like to do that because I think it's healthy to take a break from trading. Back to questions. Do you treat a reasonable buy 27 or 55 and bad signal bars differently from bad signal bars? Let me read that question again. Do you treat a reasonable buy like 27 or 55, that or that, and bad signal bars differently from bad signal bars? I'm not sure what the, because of the wording, I'm not sure what the question is. My guess is there's a typo in there. But when I see these buy the close trades where the bulls cannot get out, chances are, if you bought that close and you waited for a bull bar closing near its high, like here or here, you're going to be able to avoid a loss. It's probably going to get to 80% chance it's going to get to the midpoint of your two buys, and you can avoid a loss. And 60% of the time, it'll get all the way back to your first buy, and you can get out break even on your first buy and with a profit on your lower buy. So I'm not sure if I'm answering the question because I'm not understanding the wording. I suspect that there's a typo in the question, and I'm just not quick enough to see it, especially after a full day of trading. I'm turning my brain off, so it's hard to try to, it's like, kind of like Wheel of Fortune, guess what the missing letters are. I just don't know. Anyway, if you want, you can repost it in the end of the day, and I'll take a look at it. But 27 and 27 and 55, I think the reversal down is going to be minor and will lead to either a trading range or a bull flag. So when the buy the close bulls cannot get out like that, we're probably going to come back down and come back up to that area, or at least halfway up to that area. So whatever sell-off we get, I'm going to look to buy. All right. Hope everybody has a good night.